I could find. I'm picking up the pieces of a common time. The beauty of the island, it still belongs to you. And this is what I came for, sacred and it's true. I want you to remember, though it's time for letting go, I'm not over you. Read it in my eyes before you leave my the trees, smell the grass on your knees, feel that warm and breeze. This could be peace. See the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. You gotta see the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. I'm gonna lay back, release. Soothe my soul with the warm breeze. You gotta see the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. Gotta see the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. Gotta get on my knees. Just a humble prayer for peace. See the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. You gotta see the leaves on the trees, this could be peace. Humble prayer for peace. Smell the grass on your knees, feel the warm and breeze. This could be peace. You gotta see the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. You gotta see the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. See the leaves on the trees, smell the grass on your knees, feel the warm and breeze. This could be peace. Could be peace. You gotta see the leaves on the trees, smell
Hola, muy buenos días a todos.
Good morning, everybody. To start with, I would like to thank you for your presence here. It's a real pleasure for us to see that we have more and more people participating, and we are very happy to be able to celebrate it here in San Fernando Academy. And we sponsor the Goya collection. This is why we're allowed to use that wonderful hall for our session. Now, I would like to tell you more about the program itself. We are running a bit out of time. I will have a short introduction, and then we'll have three managers from London when they are. They will tackle quite an updated topic. David Fishwick, he's a manager and the director of the Macro Fund. Then James Tomling about the European High Yield Bond Fund and Global Floating Rate High Yield, which is a fund which has been very, very interesting since the beginning, particularly in the last year. And finally, and this is one of our new ideas for this year, we'll speak about the value fund, and we'll have Dan White for our North American Value Fund, and he's, of course, in start of the European Strategy Value Fund at 1:30. I hope you'll be able to stay with us for a cocktail, and we would like you to fill up the questionnaire kind of survey which we're having, so they can give us your opinion about our sessions, so that we can improve them even for the following years. Thank you very much. And this year, and I will just make a few comments about this year. I mean, we are facing some threats, as we know, and it's normal on a daily basis. And the main aspects which we have got here is increase in interest rates. The FED is now speaking about tax aspects, or the Trump policy, which will be the second threat for it, could be modify the increase in interest rate, which will be much more rapid than what we thought of. Some analysts think it could be even 3. China is a real threat, whether we'll have hard landing or we'll be able to convert these policy and consumption economy, and to control some bubbles which can exist, particularly in the investments and real estate. And for the long term, the population is changing in the world, as we know, and which means that the pension system, which we know nowadays, in fact, there are defined contribution. They will certainly change rules. Promotion of savings. Otherwise, the pensions in the future will be much less than what we know today. And then there's another aspect. We have to think about the fact that the American high yield reaches a maximum, and what we can have for 2017. So we'll try to answer all these questions about populism, too. The first time I saw that slide, it is based on the World Bank up to 2008, before the crisis. It was called the elephant chart. And in 20 years, since 98 up to 2008, you can see that purchasing power has been changing a lot from the poorest, very poorest on the left, and the wealthy on the right. You can see that all emerging economies, particularly China, has been increasing about 70%. But in the other layers of developed society, or the developed countries, you can see that it's not the case. Up to 2008, so they didn't earn practically nothing, really. In 20 years, the purchasing power, so to say, of these important layer of population has been losing purchasing power. If we add to that, we had the financial crisis, where normally we could have an important part of that population, which is that wealth expectations are much lower than from their parents. So the children will live worse than their parents. It's a very sad environment, really, with the Brexit and the Italian referendum. We have Citizen Trump as well. So it is really a bit of a concern. And this year, we'll have some opportunity of seeing what's in France with Le Pen, number 2, and the poll, and the Netherlands too, the right wing, in Germany as well, etc. So I think that, particularly within the EU, we can see that the different policies which have to be applied by the central banks and governments should try to satisfy better expectations of these populations. If we don't want to have more populism, because we would not like to see them in the near future. And finally, as my last slide, as a conclusion, first, it is really a crossroad policy. The monetary and fiscal policy, tax policy should work together in order to face the shifting in the democratic landscape, the baby boom generation, etc. Then we also have to align the monetary and tax policy in order to have a better distribution of the benefits of global trade. We also have Trump trying to establish barriers and protectionism, which could be negative for the world economy. And we should also consider that the European Central Bank and the Fed are starting to have a new roadmap, so to say, in order to face these unbalances which we have and which creates a lot of problems. I do hope that the following presentations will allow us to answer some of these questions from our managers. First speaker is, the importance of being flexible. I don't hear anything. All of a sudden, I'm sorry. 3.5 annually. Last year it was practically 9. And you can see the episode of Macrophone 3.5. So Dave Fish started in 1987. Yes, now. As in Prudential, and then he joined MNG Investments. He's a person in charge of these joint Prudential portfolio managers. And he's been able to use all the concept of finance, and not just a few managers can use that concept, or the daily management, so to say, and not only in the fund, and it has been a real success applying to a multi-assets fund. And with no further ado, I will give him the floor.
Hola, buenos días. I was last in Madrid in 1991, a very long time ago. It's not the last time that I was in Spain, it's the last time I was in Madrid. And the economic landscape, the market regime, interest rates, the way that the world looked at that time, stands in stark contrast to today. And that is essentially the theme that I'm going to be talking about, which is changing natures of regime, the way that the world looks and the type of investment strategies and thinking that you need to tackle some of the questions that are out there in terms of the uncertainties that Ignacio has already kind of highlighted in terms of the world economy and the way that financial markets are set up. 2016 you would regard as a rather surprising year. There were what I would call profound shocks. Now, this doesn't make it unique or particularly rare in terms of the landscape. The reality is, and one of the things that our whole investment thesis is based on, is the fact that we are, as human beings, almost permanently surprised. Is that the world turns out to be way more surprising and shocking than we ever think. And then the biggest curse of all is that as human beings, our brain won't let us believe that we didn't understand it before the event. So we all suffer from the fact that we kind of know that 2016 was surprising, but ultimately we think we kind of understood it. Whereas I think much more importantly, actually, there's a profound problem in trying to understand exactly why things happen, and trying to anticipate these events is incredibly hard. So the obvious elements of 2016 are political events, but I would say ultimately the biggest surprise is the behavior of asset markets themselves. So as I'll show in a minute, the turnaround in market behavior and investor beliefs that occurred around the middle of the year was extraordinary. And some of the transitions from fear to relaxed nature investors that occurred in the early part of the year were also profoundly surprising. So I think the lessons that we already kind of knew, really, that were emphasized again in 2016, either trying to forecast things and believe you know the future in a very clear way is a dangerous game. And it leads to complacency and an error, really, about what we think is possible to know. Safe havens, again, they were demonstrated around the middle of the year that we like as investors to clarify assets as risky or safe. And quite frequently we get that wrong. So owning long-dated government bonds in the second half of last year turned out to be a very non-safe thing to do. In the preceding phases, it had been a very nice, pleasant, relaxing and diversifying place to be. And then the last lesson that I think you already knew, particularly in kind of global multi-asset funds and macro strategies, is that the currency needs to be actively managed. So again, a lot of the volatility you've seen, a lot of the big market movements you've seen have been about foreign exchange markets as much as the asset markets themselves. In terms of the things that I think have developed, and therefore a bit of a surprise to us, are what we would regard as a challenge to the policy consensus. Now what I mean by that is that really post-2008, there was a relatively straightforward view that interest rates need to be kept low, and then we tried to suppress long-dated government interest rates as well. The idea being that we could translate that into some economic activity. And for really much of the period until the middle of 2015 into 2016, we almost kind of believed that it was really just a question of time. That at some stage, monetary policy would kick in and we'd all go back to normal. Now this particularly relates to, say, the US economy, or living in London in the UK economy as well. Less so in terms of continental Europe and less so in terms of Japan, but certainly the underlying assumption was that at some stage we'll go back to normal. And normal, in a sense, really was the pre-2007 environment, where yields and interest rates were higher, life felt, in a sense, better, and asset markets, broadly speaking, did what valuations suggest they should. So that felt normal. Now something happened in the course of the first half of last year, I think around the Bank of Japan's negative interest rate strategies and around the QE and negative interest rates in Europe, and really kind of intellectually within central banks and policy-making fraternity that has challenged this. So now something new is emerging, that maybe there are limits to monetary policy that we've already met and gone past. There's enormous suspension of beliefs. So one of the things that we track very carefully is how people believe the world economy is going to progress. And what happened from the middle of 2015 to 2016 was an enormous shift and a removal of any confidence that the world was going to get back to growth. So you may have heard stories of secular stagnation. Again, this became much more obvious and accepted. And this occurred in the middle of the year, and again, in a sense, in a slightly unanticipated way. The other thing that kind of happened almost simultaneously, and maybe is part of the same game, is a changing attitude towards risk. I've got a couple of slides that I'm going to show about how the ownership of risk has been priced in a relatively aggressive way. This turned, and in a sense was part of the surprise of the year, where in response to events like Brexit and the US election, markets didn't do what you might have expected them to do. They didn't do what they previously had done in the post-2008 environment. And that environment was very much about volatility concern, a clamour for safety, and a fear of any assets that are linked to economic growth. Now, I think that the regime is shifting. Again, part of my kind of behavioral psychology piece tells me that I shouldn't be too confident about that. And I've just said that forecasting is a very dangerous game. But observationally, if you look at the way that asset markets are behaving, continued into this year, it looks to me as if the regime is beginning to change. And this is the kind of point about flexibility, because what it's telling you is that many of the things that have been taken on board as rules to help you and guide you into the future may be about to fail you. And again, one of the obvious things there is the ownership of government bonds as some notion of a safe haven. So I think the landscape is beginning to shift, which tells us that we need to think about that very carefully and be very flexible in the way that we think about future returns and constructing portfolios. The perils of forecasting, again, if you go back and look at stuff that was written at the beginning of 2016, most of it was about deflation, hard landings in China, perhaps the oil price going down as low as $5 a barrel, a repeat of 2008, credit market implosions, global deflationary recessions. And so very much as you came into the early weeks of 2016, there were lots of people saying this is a repeat of 2008, sell everything. And markets were kind of a pretty aggressively negative with material falls in equity prices, widening in credit spreads, particularly in the kind of energy area, and government bonds rallying steeply across the globe. Now, what happened in a way that was difficult to anticipate was that from February the 11th onwards, all of that kind of just evaporated. All of those concerns started to vanish. Equity prices rebounded very, very strongly. Interestingly, led by the very commodity energy mining stocks that people had worried about the most, and credit markets began to settle down. Then you had some worries about Europe again in the year, and then you had Brexit, which in a sense feels like it shouldn't have been a particularly surprising event, but felt surprising certainly sitting there in London if you'd been watching polls. And then if you look at the market's response to that, certainly if you went through a couple of days, that in itself was also extraordinarily surprising. And then I happened to be in New York at the time of the US election, and I was out in a steakhouse watching the results come in. And as it evolved and you saw that Trump was likely to win, I was very fearful about my own portfolio positions. And again, this is a very good lesson in the difficulties of understanding what markets are. So as I went to sleep, my portfolio was losing lots of money, and I was very worried about that. I woke up, turned the TV on, and I think everything turned out to be absolutely fine. And so again, if I would have been asked to forecast the market's response to those election outcomes, I would have got those things wrong. And again, this underlines for me why often in markets we get so many things wrong and we don't understand things, is that the link between economic fundamentals and what prices are is nowhere near as normal or consistent or rational as we might want to think. So there are lessons there. This is the kind of capitulation point. So what this chart shows is sets of beliefs about where interest rates might be over extended periods of time as you've moved on through time. So the kind of key point is really that even in 2013 and 14, people were genuinely believing about getting back to normal. So we do lots of surveys of our own teams and externally as well. And this sense that at some stage we'll get back to where we came from really persisted through until 2015. In 2016, you really saw the major capitulation in terms of people saying interest rates are just going to stay lower for longer, and in some case I can't really ever see them going up in my working life. Now that is a major shift in the beliefs, and that took bond pricing to some very extreme levels and also impacted the way that equities were priced in terms of quality safe equity versus growth sensitive cyclical type deeper value equity as well. So this was a major fundamental event in the middle, or even kind of part of this sense that the market was not really understanding how to navigate the circumstances. So again, now this was also a pretty surprising thing. So this is really showing you the performance of equity, Spanish equity versus a long-dated government bond. Now, if you'd started the calendar year looking at the valuation of these assets, relatively simple valuation metrics told you you should want to own equity versus bonds. So bonds kind of feel expensive. And yet the thing that happened to you in the first half of the year is a very, very significant outperformance of bond over equity. So this is long-dated government bonds beating the equity. And then you can see in the middle of the year, something turns out pretty meaningful again. Now, again, for me, wearing a kind of behavioral psychology hat, it's very hard to pin that to hard data. So often people want to say, that happened because of. And they'll want to tell you an economic story. They'll say the world economy started to improve, things got better. Now, there was an element of that, but it certainly doesn't explain the magnitude, the size of that outperformance. So again, something pretty material occurred, signaling potentially a changing regime. And sometimes the signals about this are when valuations get very extreme. If you throw good news at an apparently expensive asset, it no longer does what you might think it to do. So normally we kind of go through life thinking that if you have good news for something, it'll respond positively. And if you have bad news for something, you get a negative response. The interesting point about 2016, and why I think it suggests a shifting regime, is that that stopped happening. And when you threw good news assets, they didn't necessarily respond in the way that you might expect them to. That is a signal that the concept of value is beginning to work in a particularly kind of aggressive way. So, why do we think this is important? It's important to us as in terms of our investment approach, because this is the sort of stuff that we try to do. So in our approach, in the macro investing side, the multi-asset funds, is to be relatively humble about what we think we can say about economics. We've learned that through our own experience of trying to do economic forecasting and finding it extraordinarily hard. So we fundamentally believe virtually nobody on the planet can be better than everybody else at economic forecasting. If you go and look at the track record of central banks with hundreds of PhD economists and mathematicians and model builders, their own track record is no better than average. And average is poor. So most of the time economic forecasting is hugely surprised. What we're interested in is how markets emotionally have priced themselves. And we're trying to spot situations where things will change as a consequence of valuations and risk behaviors having been pushed to extremes. And so this phase of market behavior is very interesting to us and very potentially important to us. And it's no surprise that in terms of the way that the multi-asset team at M&G and other teams run money is that the second half of last year, where this change of behavior emerged, has been a particularly productive phase for the way that we look at managing these portfolios. Now, the other reason why it's important, this, is that the last 5 or 6 years I would mark down as a highly abnormal phase of market behavior. And what this chart shows you here is the success of relatively naive multi-asset portfolio mixes. So interestingly, over this phase, and particularly since 2009, both bonds and equities have delivered what we would describe as abnormally high returns. So if you look at the long-run history of bonds and equities, they deliver various rates of return across regimes, but the last phase has seen very significant positive returns, way ahead of what you might have expected in a number of these markets. So that's true both of the equity, with more volatility, and it's also true of the green line there, which is the government bonds, until the second half of last year. Now, what the orange line shows you there is that without any dynamic or changing asset allocation, without any flexibility at all, you've done extraordinarily well. So many multi-asset funds that have lots of government bonds in them and moderate or lots of amounts of equity in them have done extraordinarily well. The point here, though, is that actually the guys running those funds and the whole investment community and the people investing in those funds have been surprised themselves almost without knowing it. Because the success of government bonds, the fall from yields of 3s and 4s down to 0s into negative territory, was a surprise to lots of people, including most of those people that were actually very optimistic about owning bonds. So this is a very significant event, because what it's meant is that the return profile of static asset allocation strategies has actually been very, very benign. Because if owning lots of long-dated government bonds, loaning lots of equity, has been nice and smooth because of the diversification element. Now the problem is that once you get to a point where the prospective return profile of those assets is not in a situation to be able to deliver this, is that you then need dynamic asset allocation strategies and you need to have some flexibility. So one of the things that we think has started, that began in the middle of last year, is a phase where bonds don't deliver you equity-style returns anymore with negative correlation to equity. So they've been wonderful assets to own. They've been superbly positive return generating, and they've also been a safety asset when times of difficulty in risk assets has emerged. So effectively what we're really saying here is that the phase of behaviour of a combination of government bonds and equities, which has been a very pleasant one, there's a strong chance that that is drawing to an end. And that actually, if you're going to want returns from here, you're going to need to buy some risk. You're going to need to accept some volatility in and around that. The other thing that's very important within this that's changing is the type of equity that you own. So again, what I would describe as that post-2008 environment where investors have wanted certainty and safety led them to buy particular types of equity. And in many cases, the valuations of those assets that were seen as safe equity got to relatively extended valuations, and certainly against the assets within equity that you would describe as being risky or growth-sensitive types of equity. Now, as an asset allocator, that same behavior manifested itself at the asset level too, so a preference for bond over equity. And so in the post-2007 environment, which is that kind of peak up there, 2006-07, you've seen a phase where backing value, in a simplistic way at least, backing value has been a losing strategy. And we know ourselves, using quantitative valuation frameworks to choose which parts of assets that we want, is that you've been fighting a losing battle if you just backed value. You've had to do other things, and in our world it's to exploit volatility in an episodic way. Now the nice little line at the end there is, in our view, the beginning of potentially a more meaningful change, where all of a sudden, pretty rapidly, equity assets have begun to behave very differently, and value styles have tended to do extraordinarily well. Now this is very, very meaningful, again, for investment strategies that are, in a sense, carrying on what's worked for the last 3 to 5 years. In our view, they're very much at risk. So again, that relates to the asset class level, so bond versus equity, but also the type of equity that you want to buy. And all of this really relates to a changing sense of risk perception, which is wrapped up in a changing, potentially, policy environment. Arguably, the economic cycle itself is at a different phase, and beliefs have changed. And a lot of it is about how we perceive risk, how we think about risk, whether we're clamoring for safety or not, or whether we're actually willing to tolerate some volatility. The challenge to the kind of policy framework really relates to, as I said, the end of a belief that monetary policy can solve everything. And again, there's nothing really new in this. It's just that governments pretty much across the world have adopted a view that budgets must be balanced, and as a consequence, the only tools really available to try and stimulate growth have been interest rates and other unconventional methods of monetary policy as well. But what's happened as the course of the last 12 months and persisting right now is really challenges to that sort of set of thinking. And that opens up potentially a very different economic set of circumstances with new risks, which again then should feed into the way that you think about how to price the various different assets that you've got available to you. Now this chart is a little difficult to interpret, but is really just telling you what yields, future returns look like in real terms on assets. So it goes all the way back to 1990, and it looks at the transition from higher levels of cash real rates, higher levels of real bond yields, down to this negative real return prospect that you've seen, and then the orange line, which is looking at global equity yields. So that is an earnings yield. It's telling you if companies grow, what sort of real rates of return you should expect. Now, the interesting things are some different regimes that you can see. So something very odd happened in the middle of that slide around 1999, where at least momentarily, the orange line actually dipped down below the green line. It's not shown on that chart because it's not high frequency enough, but I was there and it happened momentarily. And that's, in a sense, investors in equity paying to own equity risk versus bond risk. Now, if you think about how different that is to the landscape of the last few years, where people have said, if you want me to take equity risk, you're going to have to pay me very, very large extra rates of return, which you can see. So from kind of '08 onwards, that orange line sits way, way, way above the green line and the blue line, which are real rates of cash. So bond yields, real interest rate structures have effectively been on a 30-year downward trend, in a sense, as regimes have shifted. The equity, people loved equity in the 1990s, fell in love with owning equities, and then have spent much of the time following that really being very difficult to get them particularly excited about owning equity. Now again, that gap still remains extraordinarily large. And again, for me, what it's saying is, if you kind of think about regimes and where this might head, is that there's a high probability that owning that orange line in terms of its prospective real returns is going to be better than owning combinations of the green and the blue. The problem, as ever, with valuation-driven perspectives on markets is that I could have said that to you any time in the last 4 years. And yet what actually happens is, until the middle of last year, bonds carried on, in many cases, beating equity. So you always have to be kind of careful about using valuation as a too clear sense of timing. But I would say that there are encouraging signs about the behavior of asset markets and all of the kind of policy-making ideology stuff that I've talked about in terms of maybe we're entering a new phase. So our response to that is to say the success of those naive asset allocation strategies, multi-asset strategies, is unlikely to be extended. And if you want to have some success and generate returns, you're going to have to change the mindset and be happy enough to own equity assets. Now, in terms of the macro episode fund, macro episode is a kind of different type of multi-asset fund in that it's totally unconstrained. So it has no ranges. It has ranges that we ourselves have constructed in terms of thinking about how much equity would you ever own. And all importantly, of course, in this fund, we can also go short of assets. So it can bet on falling bond prices, falling bond and equity prices, and importantly, therefore, it has the flexibility to protect you in environments in which assets don't do well. So if you think about the last 5 years, both bond and equity have done very well. That isn't always the case. In macro episode, where we can go short of things, we have the ability to protect capital in environments of falling prices. The way we think about it, though, in terms of coming up with ideas and implementing, is that, again, coming back to what I said about surprises, we're very anxious not to get engaged too much with trying to forecast surprises. We think that they're going to be happy. So we don't really look at economic forecasting prowess. What we do is try and focus on observable facts. The environment is unstable. That's actually good news for us, because much of the thesis that we have is about excess volatility in the system and a willingness to try and exploit that. So again, the environment at the moment has been fertile, and the value element of it now is making it more fertile again. We believe that traditional safety assets that have served you very well until the middle of last year, are very, very vulnerable, but there is a broad universe out there for us to pick of attractive assets, and importantly, this dynamic about being able to short. When we look at the landscape today, trying to make sense of where we are, this is just another way of representing my previous chart with the orange and green and blue lines. The left-hand side, you've just got real cash rates and real bond yields, and on the far right-hand side, you've got clusters of equity all the way out to emerging equities, some of which feels very frightening, but is offering you double-digit rates of real return forever. So our interpretation of the landscape today is that really buying diversified baskets of assets out from the middle versus cash and versus very defensive government bonds is a very attractive thing to do. So most of the funds that we run, and macro episode itself, is that way. It is short of high quality government debt assets and is long equity assets and then has some geographical and sector preferences that reflect some of these valuation signals. So as I've just been describing, it's long of Asian equity, but US banks, which again emotionally are an area which has been unpopular until much more recently, and along with European equity, which has included Spanish equity, but more recently also Italian equity. And against that, we're outright short of what we regard as dangerously priced government high-quality debt. And on the right-hand side there, we've got some currencies. Just recently, we have been taking on things like the Mexican peso and the Turkish lira, which are very frightening things to take on. It's part of our investment thesis that we want to take on things that emotionally investors are finding it difficult to do. And so far in February, those two positions have added about 3/4 of a percentage point to the fund's return, and nicely have been quite diversified versus other things, which is another element of the investment thinking that we have, which is that valuations take things to levels that then cause significant changes in correlation and provide you with a lot more diversification than you might ever think. And against that, in a sense, we're kind of short of low or negatively yielding currencies where people have felt more safe against some of the volatility that you've been seeing. Now, this varies a lot through time. So in the life of the strategy that I've been running since 1999, we've been long and short of all of these asset classes. And sometimes we go much more granular and specific in terms of the exposures. Other times it's much broader and closer to what you would think of as more generic indices of ownership. So, to conclude, you will notice that I haven't given you any clear prescription for what the world's going to do this year. Many people who run money in a similar type of strategy to us in terms of funds will often start these presentations by saying, this is what's going to happen in China, that's what's going to happen in Europe, this is what the US is going to do, and as a consequence, assets are going to do this. The whole point of what I've been trying to describe to you is my chance is that they had absolutely no chance on earth of being right. So if you actually had, even if you knew what the economics was going to do, you scarcely would necessarily be able to interpret what markets are going to do in response. That is the important lesson of 2016. So confident, view-based strategies, in our view, are highly dangerous and are deeply flawed. Instead, what we try to do is understand how surprising and difficult the world is and back odds, as described for you by valuations, with a sense also of the emotional element, so that we're trying to do things in these portfolios that aren't obvious and are contrarian to what prices have recently been doing. And we're very encouraged by the events of 2016, as I've said, and by recent price behaviour that's mapped on in the second half of last year into this year as well. So, there is a risk, of course, that I'm completely and utterly wrong about all of that, and that actually the world's going to revert back to where it came from in the post-2008 landscape. But we're pretty encouraged by it. So we think that this is part of a longer-lasting move and is a regime shift, and that has profound implications for where you want to be placing your funds into the medium term. Importantly, the whole notion of safety is a very interesting thing that needs thinking about. So a lot of assets that are perceived as safe in our view are not particularly safe at all. And part of this is a shifting element of policy-making consensus, the use of fiscal policy, and importantly, if you go and look at the facts about when markets have moved, it clearly isn't just about Donald Trump in a sense. I mean, Donald Trump is a symptom of some of the same things. And as I showed in terms of the valuation, if we're right about a multi-year regime shift, the opportunity to do incredibly well in some assets and badly in others is enormous. And again, my observation, having done this job for 30 years now, is that these types of regimes last for many years and often an awful lot longer than people would expect. So, and it's an important conclusion, which is that we need to understand the potential for regime change and market behaviour change, and we need dynamic asset allocation strategies, and in my view, a willingness to tolerate some volatility to try and generate some returns. And I will finish there. Thank you very much.
Tenemos cinco minutos.
5 minutes for questions. Have you got a question, please?
Tenemos micrófonos.
Got some mics.
Si no hay preguntas, I will ask you something. So, do you believe that we are going to see another volatile year?
It's a very interesting question. So, again, there's a behavioral answer to this. So, having seen a volatile, surprising year, what we now do as human beings is expect another one this year. It would not surprise me, actually, if the volatility, should it emerge, comes from areas we haven't thought about. So we kind of know about European elections and the populism and some of the dynamics that we've been hearing lots about. But it strikes me, actually, it's highly plausible that the correcting tendency of valuation means that actually you could be in for a phase where you don't get huge lurches and reversals in markets. Having said that, there are some interesting dynamics to do with tightening credit spreads, to do with iron ore prices and various things that don't look stable. So in the aggregate, it feels like things are relatively low volatility, but within that, there's a lot going on. So it all kind of depends on what we mean by volatility. But I think most people think of what it's felt like since 2008. I think it's going to feel different.
Okay. ¿Alguna? Sí.
Hi. Hi. After you decide your asset allocation, how do you select the underlying investments? Do you take any process, or could you describe it a little bit, please?
Yeah, so in the area of macro episode, which is clearly a kind of a slightly different fund, we don't try to be too clever with the underlying investment. So mostly it's a derivative-based strategy where we're taking on aggregate equity indices, occasionally sectors, and then it's all kind of liquid derivative strategies. Now, within the rest of the multi-asset funds, though, where in a sense they have a longer neutral position, so that if they're neutrally allocating, they will own equity and they will own bond. There we use various different underlying elements. And so again, we'll target certain sectors and geographies, often using our own internal funds run by M&G's fund managers, but a combination of that with underlying derivatives as well. So the fund that I run in particular is very kind of macro-oriented, and we don't try to be too clever about the underlying investments themselves. And as again, because you're trying to exploit episodic volatility, the kind of buy and hold thesis doesn't really apply. So we can put trades on in response to Brexit, and then 3 weeks later those trades are not there. So again, asking a long-only fund manager to run those exposures for you doesn't really make quite as much sense. So as liquid derivatives is the way that we're running that.
Okay. Una pregunta más, sí.
Hi. Would you say that there's still room for real yields to still go on a downtrend pace? So would you say that TIPS in the US could be an interesting asset class?
So I didn't...
Tips, inflation.
Tips.
Could be back.
Tips.
Yeah.
TIPS in the US.
It's interesting. So although I think there's a lot of talk about inflation, you know, my stance still is that the world's problem is that it's too good at supplying. So if you think about inflation, there's a kind of demand and a supply function. I think ultimately inflation remains relatively low and stable globally. And so for me, protecting against inflation is maybe worthwhile as an investment thesis. But again, it would always just come back to the odds that you're being offered. And I guess, you know, I think at the multi-asset level, we can find better alternatives than that as a way of trying to think about the inflation issue. Ultimately, though, you know, TIPS have been a great asset to have owned. The interesting dynamic in a sense is that they've not done it via actually providing inflation protection. They've done it by real yield compression. So again, it's not obvious to me it's a stunning thing, but there's no reason why I wouldn't have TIPS as part of an overall multi-asset portfolio.
Okay. Yo creo que lo vamos a dejar aquí.
I think we're going to leave it at that. David will be with us during the cocktail, so you can ask him some more questions.
Vamos a pasar a la segunda presentación.
Alex will listen to the second speaker. And I've said before, with it a fixed income, the governments are not much interested. They rather work on the short term. So some managers working in cashes, but there are other possibilities within fixed income. It is high yield.
Los retornos y la rentabilidad.
So with quite a low yield. And we will listen to James Tomlins with a global high yield. And with more than 1.3 million euros, and the maturity of 451, and then the yield at the beginning has been very good indeed, above the Morningstar index. The second fund, James will speak, is a global floating rate high yield. It's very easy to remember all these names, he says, which has been launched in 2014, thinking about the increase in interest rate. The manager is James, the manager is James, more than 2,000 million euros right now. And the yield to maturity is a bit lower than the one you can see here. Yes, lower than this one, yes. It's about 4.3. But anyway, he will speak more in depth in a minute. And you can see that one of the specificities of the floating yield is more conservative, about 50% what you get in the normal high yield. So if you don't rely much in the fixed income, you have less volatility compared with the traditional high yield. James joined M&G in 2012. He is an expert, as I've said, in high yield bonds, and he uses that experience in these two funds and in other portfolios too, such as optional income. With no further ado, I will give him the floor. Don't speak too fast, please.
Thank you. Thank you very much, Ignacio. And it's great to be back here for two reasons. I was here last year, but it's always nice to come back to Madrid. So that's the first reason. The second reason it's nice is that just before, when you have a multi-asset investor having a big presentation, and they usually don't like bonds, and then a bond investor has to get up and tell you why their fund is so fantastic and amazing, it's always a little bit awkward and a little bit incongruous. But on this occasion, I completely agree with David Fishwick, and I'm going to go through some of the reasons why. But effectively, this time last year, we were very bullish, quite bullish on high yield. It was a great entry point for the asset class. Spreads at 800, 900 basis points. US high yield yielded 10%, double-digit yield. A lot was already priced in. A lot of the bad news was in the price. That bad news dissipated and prices reacted, and you had some great returns. Now, however, it is a very different situation. The global markets are not so concerned about bad news, and that is fully in the price, and the prospects of the kind of returns we saw last year are now very diminished. So that's really the main message of this part of the talk is, I think return expectations for high yield have to be materially lower than they were this time last year. And I'll go into more detail how we are positioning the portfolios accordingly, both the global high yield funds and the global floating rate high yield. But this is in a sense what went on in terms of the market reaction. Particularly the biggest reaction was the post-Trump environment. Looser fiscal policy coming through from the US. What does that mean? So that's actually a relatively good thing for credit investors. Nominal growth, higher cash flow, higher turnover for businesses. That will dominate concerns over interest rates, but effectively it's good for credit spreads. So we have seen a reaction from that, but arguably we've already had a lot of that priced in. LATAM protectionism. So the trade policies that we're likely to see from the Trump administration, likely to see trade barriers increasing. We did see a moderate repricing in Latin American credit spreads. It does form a part of the high yield market, more so an issue for emerging market bond funds, but most of the move has been the repricing of FX markets, particularly the Mexican peso. So again, the impact has been fairly benign and is unlikely really to be a big negative going forward for global high yield. Foreign policy is more of the concern for me. I think there are a lot of checks and balances in the US Constitution. So domestic policy, it's very hard for the president to do what he wants. Congress holds the purse strings, you have an independent judiciary, and they've already shown how that can work in practice, particularly with the reaction to the proposed travel bans that the Trump administration tried to bring in. So domestic policy, I think, is less risky. He does have a lot of executive power when it comes to foreign policy, and we're starting to see the unpredictability come through there. It may be fine, it may not be fine, we just don't know. So I think it's a little concern I have that we may see a foreign policy issue that has big market impacts going down the line. The Fed, I think there's nothing controversial here. The fiscal policy response from the Trump administration, coupled with tax reform, is going to mean higher US deficits, but also more inflationary pressures likely to come through. Now, the market's been quick to price that in, and you can see the Fed has shifted to a more hawkish stance. Indeed, we saw the minutes released last night, and I think a March hike is not expected, but it's not impossible. But maybe 2 to 3 further hikes this year by the Fed is expected. And healthcare, for the high yield market in particular, healthcare is a big sector. There have been some definitive implications. Obamacare being repealed is generally bad news for hospitals who are service providers, and that's helped drive revenue and passenger numbers through, patient numbers through those hospitals. Whereas for the pharmaceutical industry, the initial reaction was positive. President Clinton would have been outright negative for the pharmaceutical industry. Very aggressive review of pricing structures and patents would have been the first response from that administration. Trump administration initially has been proven to be business friendly. We may see a populist reversal. Pharmaceutical and drug prices is a very political issue in the US. Perhaps he will be more benign. Perhaps he will use it as a populist tool. So a lot of moving parts, but generally speaking, that's been a definitive sector impact. So what's that meant for total returns? I mean, I think the clear thing is the environment over the last couple of years has been pretty benign for the high yield market, with that one period where we saw a big energy price sell-off. And particularly you can see that hurt the green line more so than the others. And the green line is the US market, and energy was the biggest single sector in the US market. So you had financial leverage and operating leverage for these businesses. And in fact, we did see a huge amount of defaults being priced into the market, and indeed a very high default rate in that sector. But we'll go into that in more detail later. What I would just point out, though, is if you look at the orange line, and that's the European high-yield market, that had, broadly speaking, the same return over that period, but you can see the drawdown and the volatility has been a lot less. Now, there's two big drivers that I think have big implications going forward. The first one is the move in the Bund. Obviously, the Bund has repriced much, much lower over that period, and that's been very supportive for total returns. And the second is energy and cyclicality exposure in that market. There is less than 5% of the European market is exposed to energy. So you didn't get the drawdown, but likewise you didn't get a very sharp rally that drove returns in the US last year. Now, what does that mean going forward? Well, I think going forward, we're, in my view, very unlikely to get that supportive price action from the Bund. So I think returns going forward, it's much more favourable for the US market than it is potentially for the European high-yield market. The floating rate market, you can see, didn't have that support from the Bund. The floating rate market, or the Treasury, the floating rate market is a zero duration asset class, but you can see its returns have been dominated by what credit spreads have done. So it did see some weakness back in 2016 and early 16, but then again participated in much of the rally going forward. However, you can see the volatility again is slightly less than conventional market, and again, we'd expect that volatility characteristic characteristic to be similar going forward. So for example, the M&G Global Floating Rate High Yield Fund has roughly a 50% beta to conventional global high yield, fixed rate high yield. So in strong markets, we tend to underperform. We did about 50% of the return of the global high yield market last year, and vice versa. When we've had periods of sell-off and drawdown, we've lost a lot less, about 50% less than conventional high yield. So if you are looking for a lower beta way to gain exposure to credit spreads without interest rate risk, that could be an interesting strategy, an interesting way of doing it. And this is what credit spreads have done. I mean, ultimately, credit spreads are more important for high yield returns than anything else. Credit spreads and defaults. Interest rate risk is important, but it is not the biggest driver of returns. It is credit spreads. And again, you can see this time last year, it was an excellent entry point. You had recession fully priced in to credit spreads in the markets. And now we're sitting around about 400 basis points over. Now 400 basis points isn't necessarily a bad price for the fundamentals right now. It's just the scope for further capital upside, total return upside is very limited. And I think in theory, we could see maybe 50, 75 basis points of tightening. This is if. A big if. This is speculation. I don't know what's going to happen. But you can see the quanta, the amount of that credit spread move is very limited versus the several hundred basis point move tighter we had last year. And that has big implications for total returns going forward. It's coupon that's going to drive returns now, not spread changes. In fact, the biggest risk is that we have spreads widening, going back up to elevated level in a crisis, and then we're likely to see capital losses come through in this asset class. That's probably more of a concern than missing out on spreads tightening. Why is 400 basis points not necessarily a bad spread level? Well, this is the default rates we've seen over the past few years, and spreads ultimately compensate you for default risks. It looks actually, they may be a bad situations, particularly in the US. You can see default rates are actually picking up, and that's driving up the average. European defaults, by contrast, you can see actually very, very low. But we think this is an optical illusion, and this is why. So the US default rate is really being driven by one sector, again, the energy sector. Energy sector defaults peaked at 27%, so almost a third of all energy businesses in the high yield market defaulted over the past 12 months. That number is going to fall, and is falling very rapidly right now. So the businesses that had high costs and a high leverage, they've gone. They don't exist in this market anymore. The businesses that have survived have much better balance sheets, they're much more efficient, and now they've benefited from 6 months, almost a year, of rising energy prices. So that default rate will trend very quickly down. That means the overall default rate will trend back down in the US, and you can see if you X out energy, actually defaults are still at a consistently low level of 3.3%. So, long story short, we think defaults will probably be around about 3.5% on average for high yield this year. Therefore, a credit spread of around about 400 is not necessarily that bad. It's just not great when it comes to expecting total returns to be very high. And then all-in yields, you can see the impact of moving between the different regions in terms of all-in yields. So, 6.2 for the dollar market is not a bad income proposition. But the only way European investors can get that 6.2% is to hedge out the currency. And the currency hedging costs you around about 1.8, 2%. So in reality, it's 4.2% for European investors if they're not willing to take the currency risk. The European market around about 3.2, you can see, again, we're looking at very, very low yields on a historical basis. So the entry point right now for all high yield assets is very, very limited when it comes to total returns going forward. So what could these returns be? Again, it's very clear to state, I have no idea. I do not know what total returns are going to be for the high yield market. But the beauty of fixed income, and I love fixed income because it's a complete geek, is you can actually calculate lots of scenarios and come up with a number. And these are the scenarios we went through. So for a change in credit spreads and a change in government bond yields, and we've assumed a flat move in the curve, a parallel move in the curve. So plus 0.5 means US Treasuries reprice up by 0.5%, but also you get 2 rate hikes in a year from the Fed. These are the outcomes. On the top, the number on the top of each box, and make sure I've got this the right way around. Yes, the number on the top is the floating rate market. So that's the market that's less volatile with spread, but has 0 interest rate risk. And the number on the bottom is the conventional high yield market. So higher beta when it comes to credit spreads, but you also have some interest rate risk with it as well. Duration, interest rate duration for conventional high yield is about 4 years. Duration for the floating rate market is 0, effectively. So you can see, this is in US dollar terms, to be clear. So for a US dollar investor, mid to high single digit is not actually unfeasible. Our base case is that we may see a little bit tighter in spreads, but we're quite negative on the prospect for yields. So probably ending up in the middle towards around about here in the bottom left-hand side. And you can see that's actually not a bad environment for the floating rate asset class. You still get a positive return. Now, the problem, however, is when you look at euro-based returns, you apply a euro-dollar hedge cost to that, and you take out the LIBOR differential plus the FX basis, you start to get much smaller numbers. Unfortunately, that is the reality right now, given ECB policy. So the base case goes from that mid-single digit right down to low single-digit type returns. And that is in gross. That's before any potential fees you have to pay. So this is why I think it's very, very important to manage expectations. Again, last year, great entry point for high yield. Right now, not so great. Now, the converse argument that's been put to me has always been, well, it's not great anywhere, particularly in cash, so you have to take some risk, and perhaps this isn't a bad risk to take. So when it comes to that, I think it's acceptable, but you have to manage the portfolios accordingly and realize that the opportunity cost of being very aggressive is very low. It makes much more sense to keep portfolios defensive within the asset class, try and clip the coupon, try and get the income, but don't risk your capital. And when I say don't risk your capital, that means more defensive credits, more senior secured credits, and in less cyclical sectors. So within that, what are the portfolio themes? And I'll focus on the 3 key themes right now. So energy versus non-energy was the big sector trade of the last 2 years. And a quick example of what that could have meant if you were in energy and if you were not in energy. So this is 2 bonds. One is Ardagh Packaging, a business we like very much. It's a fairly stable, non-cyclical business. It's got a bit of financial leverage. And then Chesapeake Energy. Chesapeake Energy is the biggest single energy issuer in the high yield market. They're a US shale gas fracking business, basically. And you can see the price moves over the last 2 years have been pretty extraordinary. The Chesapeake bonds traded from par down to 15 cents in the dollar and are now back pretty much at par. So I think it's fair to say that our sector view has been, broadly speaking, correct, but our timing could have been a lot better. So we were underweight energy going in, we maintained that underweight on the way back up, but I don't think there is any reason to change that view right now. That trade has gone. There is more risk, but less return now for energy credits. It's priced for a very benign outcome, but there are still arguably some risks on the downside. So we're maintaining that underweight. and we see no reason to change that. We want to be maintaining an overweight to businesses like Ardagh Packaging, which are much better set up to survive periods of volatility. And if we do see risk premia adjust and a sell-off, we have that ability to cycle the portfolio back into cyclical credits. Financials. This is more of a recent theme. So one of the issues we've seen is, particularly in Europe, is a distortion of investment-grade credit spreads. So the ECB and the Bank of England buying corporates, that has been particularly positive for those spreads, but it has distorted the markets. Financials are less distorted. However, you've got to be very, very careful about which financial you're exposed to. There are still landmines out there. One example we have here is Monte dei Paschi versus Credit Suisse CoCos. So Credit Suisse, you can see on paper, this should be a riskier investment. It's equity-like. They can turn off the coupon and they can actually take away some of your capital without defaulting. The Monte dei Paschi bond was a lower tier 2 bond. That coupon cannot be turned off and the bond cannot be equitized without an event of default. But of course what happened is there is no event of default in Credit Suisse. Things are recovering, capital ratios are getting better gradually over time, and the sector is still trading reasonably cheaply. The Monte bond, you saw the failure of the private sector solution last year. The state had to step in. Institutional bondholders are seeing losses of up to 50% of their face value. So there's very much opportunity in the sector, but you have to get the stock selection correct. There are still landmines in financials. So some value, but be careful where you tread. Final theme is a little bit more of a technical theme. So we have historically liked the US market over the European market, and this is ignoring duration, ignoring cross-currency, but purely on a spread basis, US dollar double Bs looked much more attractive over particularly last year, versus European double Bs. You got some risk premium and better underlying fundamental dynamics. But post-Trump, that rally in US spreads has suddenly made some European double Bs look more attractive. Again, there's not a huge amount of difference between the two. In Europe, you've got more political risk, arguably, a growth issue, but companies are quite defensive, they're quite cautious and manage their balance sheets accordingly. In the US, you've got more growth, but the companies are much more aggressive. They're willing to lever up, they're willing to take on more financial risk. But recently what's happened is that some of the European double Bs are looking much better value. And when you add in the cross-currency hedging cost, suddenly it looks even more attractive. So we've actually moved the portfolio away from the US a little bit and back into Europe to take advantage of that. It's not going to be a major performance driver, but we think it's a very nice theme to play right now in the market. So ending on fund positioning, hopefully there won't be too many surprises, but the key risk metrics for the two global funds you can see below. Interest rate risk, I won't labour this too much, but we are slightly underweight duration in the global portfolio at 3.2 years. Global high yield has a duration of 3.7 at the moment. It tends to hover around about 4 usually. And you can see, but the big difference though is between the two funds. The floating rate fund will always have a duration of 0.1 or 0.2. The maximum it can ever be is quarter of a year. All of the underlying bonds are hedged back or indeed have a coupon that's pegged off 3-month LIBOR. So whatever happens to the Bund, whatever happens to the Treasury, will have almost zero impact on the prices of the securities in the floating rate portfolio. Indeed, Fed hiking is good news for that portfolio if you are a dollar investor. If the ECB ever tapers and in the future hikes as well, then you'll get the benefit as a euro investor. Spread duration is probably the more important metric here. So you can see the global high yield fund, again, we've moved from being neutral to overweight almost all of last year to now a more defensive stance. We could move more defensive if the market gets even more expensive, and that looks like the direction of the travel at the moment. The floating rate spread duration is about 3 years, 2.9 years. It looks like it's actually overweight credit risk, but there's various technical factors which artificially compress the number for the index. The index right now should have around about 3 years of spread duration on the downside, but only 1.5 years spread duration on the upside. And without going into too much technical details, that's because of the convexity issue of the portfolio versus the index. We actually want a little bit more convexity in our favor in the portfolio than is available in the index. But it will have roughly the same duration on the downside, but it has more upside for various reasons. And in a little bit more detail into the fund position itself. So this is the Global High Yield Fund. You can see our biggest single country exposure is still the US, but we've moved from an overweight to an underweight. We're investing back into European double Bs at the moment. But a global fund, its biggest position will always be the US. The US market is 2/3 of the global high yield market. So naturally, there'll be a bias towards the US anyway. But we're shifting down away from that in favor of some European risks. Probably more important, though, is the sector positioning. You can see consistently we are underweight for cyclical businesses. The risk premium for cyclical businesses just isn't there. You're not being paid as an investor to take risk, cyclical risk, given what's happened to spreads. So it's very easy to increase the overweights in a defensive business where the downside is much less should we see a sell-off in risk premium. And the upside you're giving up is de minimis. It's very small should spreads carry on rallying aggressively. In the floating rate portfolio, we do use some derivatives in the portfolio. That helps manage liquidity, but ultimately the outcome is the same. We want to give you exposure to credit spreads, but with zero interest rate risk, and that's effectively how we use them. So again, spread duration, a little around about 3 years, but interest rate risk 0.16, 0.2, 0.1, that won't change. But more importantly, again, is the sector distribution. I wouldn't say there's a huge active view by country. It's a different market. It's a much more of a European-heavy market. But again, we've got some active positions there. More important, sectors. Again, consistent view. We quite like the less cyclical businesses. Media is cable businesses. Financial services is non-banking financial businesses. Services is more of a stock selection thing. But the underweights are the more important ones. Underweight retailers, particularly UK retailers, where we have concerns about inflation and wage pressure there. Banking is more of an underweight to the second-tier European banks in this market. So we do have exposure to Wells Fargo, JP Morgan, Credit Suisse, UBS, but we have zero exposure to Monte dei Paschi, Veneto, etc., the more challenged European banks. And again, maintaining that underweight to energy. In hindsight, it would have been lovely to have lots of energy this time last year, but again, that would have had big volatility considerations, and frankly, that trade has now gone maintained. There's no value there for going overweight. The final thing I'd say is by financial tier, this is the other big difference between this fund and conventional high yield. This is a little bit out of date, so we have just under 60% of the portfolio in senior secured bonds. These are bonds that are secured against the assets of a company and are typically sit alongside senior loans in the cap structure. So you get much more downside protection and default. Recovery rates average 60 to 80% of your money back on average for that type of bond. The equivalent number in the global high yield market is 17% senior secured. It is an unsecured heavy market, and because of that, recovery rates tend to be 30 to 40% of your money back on average. So if we do go into a default cycle, and if we do see credit spreads widen, this fund is positioned in a defensive way against conventional high yield. And again, that's one of the reasons why the beta of this fund tends to be around about 50%. So I'll finish up with three broad conclusions. The growth and the macro outlook is actually pretty good for high yield credit. Nominal growth plus low defaults solves to generally a benign environment, albeit there are still risks. No, we could get a macro shock, we could get a political shock. The problem is valuations. Valuations have already priced in a lot of the good news. We're not far off the tights that we've seen over the last 2 to 5 years. So that, again, the scope for capital upside is very limited. It's about coupon and limiting your risk on the downside right now. In terms of the portfolio position, you can see there are some active opportunities within the markets. Some of those themes are playing out right now. And again, particularly in banking, that could be very interesting in the short term. But overall, we think now is the time to maintain a defensive position given the outlook for credit spreads and given the need to preserve capital right now rather than take too much risk. And I will end there. Thank you very much.
¿Alguna pregunta para James?
Question for James? No? So, yes, I've got. So
Liquidity in the high yield market
Yeah,
now.
it's a very good question. So liquidity, in a way, has been quite good over the last year. We've been able to move the portfolios around. The trading desks at the investment banks are maintaining a lot of capital in the high yield part of their market because it's profitable for them as well. However, what we're very conscious about is this liquidity can change and it can get very bad very quickly when we have periods of distress and the market sells off. So what we try and do is we maintain excess liquidity within the portfolio. And we can do that 2 ways. We can just hold more cash on average. That has performance implications. It creates a cash drag when the market's doing well, but that's just the reality of it. Or we hold some derivatives. So as David Fishwick says, actually a derivative market can give you the right risk-return characteristics, but in a much more liquid form than underlying. So we hold, on average, at least 10% of the portfolio in CDS contracts, index contracts, are much, much more liquid than the underlying market. And we've used that when liquidity's been very bad in the physical market. So it's okay, it's functioning at the moment, but we're trying to build in some cushion, some insurance against bad times in the portfolios now.
Thank you. ¿Alguna pregunta para James?
more questions? No? So let's go on because we are running out of time, I'm afraid. James, thank you very much. Now we'll start with the last presentation. He's one of the about really the most interesting income equity fund. And we've got Dan White, the manager of North American Value Fund, and from IG North American Value Fund with a very similar strategy, and which seems to be interesting for investors, with a good reaction in the markets since August, I would say. The big question is, are we entering a multi-annual situation in which the value will go better than what we have known in the last 5 years? Now, profitability has been good, and the North American Value Fund in 3 months, 11.9%, 31% on a yearly basis, the first quartile to the index, better than the peers. So the strategic value, the same thing, and at 1 year, 2 and 3 years, with the European Strategic Value Fund as well. Dan started in 2005 as an analyst on equity. Been working with Richard Halley, who is the manager of European Strategic Value Fund since February 2008, and he's the deputy manager of that fund since 2013, manager of the North American Value Fund. I will give him the floor.
Thanks very much. Good afternoon, everyone. Thanks very much for your interest and attention this afternoon. So I'm going to talk about the 2 funds, the North American Value Fund that I run and the European Fund that's run by my colleague, Richard Halley. I'm going to talk about 3 areas. I'm going to talk a little bit about our philosophy and our investment process that we employ on both the funds. I want to talk about why we think now is a really interesting and exciting time to be considering a value strategy, both in Europe and in the US. And then I'll touch on how the portfolios are positioned currently in order to best take advantage of the opportunity set that we see within the market right now. Before I do that, what I really want to talk about is basketball. Now, last month, I came across a really interesting article in the Wall Street Journal that I really wanted to share with you all today. This article, it was about a high school basketball team out in Minnesota. It's called Pine City High School. And the article was specifically about the coach and the strategy that he employed in terms of his coaching of the team. The coach's name was a guy called Carl Allen, 29 years old, a little bit younger than myself. But Carl was a pretty interesting guy. He was actually the sociology teacher at Pine City High School. And back in 2011, the principal or the headmaster of the team approached Carl and said, look, you know, we're going through budget cuts, we're having to cut down on it, we're having cuts to our funding. We can't afford to employ a dedicated basketball coach. Is it something that you'd be willing to do kind of in your spare time? And Carl thought for a minute, he thought, well, you know, I like basketball, I'm interested in basketball, I don't really know much about coaching of a basketball team, but, you know, it sounds like a great opportunity, sure, I'll give it a try. So he goes on to the first sort of session, the first practice with the team, he's feeling really excited, he kind of walks in the room and all of a sudden he feels really depressed. He looks at the guys that he's going to be coaching, he looks at the team, they're all pretty small. There's nobody on the starting lineup that is taller than 6'2" at Pine City High School. And if you can imagine in a game like basketball where height is a pretty strong competitive advantage, having short players, you know, does put you at somewhat of a disadvantage. The players themselves, you know, they were kind of average in terms of their ability. They weren't particularly poor, but they weren't particularly great either. So Carl's standing there, he's standing there on the court, he's feeling a little bit depressed. He's like, how on earth am I going to coach this team? How on earth am I going to deliver the sorts of results that the principal is no doubt expecting of me? And as he's standing there, he's kind of looking out onto the court and he thinks, the answer's here, the answer's staring me right in front of my face. I think as many of you will know, in basketball, you've got this line, this three-point line. So any shot that you take from inside the line and it goes in the net, that gets you 2 points. If you take a step back, you make the same shot from outside of the line, it gives you 3 points. So if you think about it, there's a pretty significant pricing inefficiency in the scoring mechanism for basketball. A shot that is no more really technically difficult or challenging, you're just having to move back a foot or so, gives you 50% higher returns, it gives you 50% higher points. So from that point onwards, or from that period onwards, Carl and his team focused exclusively on shooting three-pointers. So any time that they have the ball, even if they're close to the net, they'll actually pass the ball further away to behind the three-point line to try and exploit this inefficiency. Last season, 96% of the shots made by the Pine City High School basketball team were three-pointers. They were taken from behind this line. This is higher than any other high school basketball team or even NBA professional team. So this is something they very much focus on. Now the players, they absolutely love this style of play because effectively what Carl has done is just given them one thing to concentrate on, one thing to practice and one thing to do incredibly well, and that is practicing three-pointers. So they don't have to worry about practicing any of the other sort of shots, the kind of sexy, glamorous slam dunks or what have you. It's just all about three-pointers, day in, day out in terms of their practice. The fans, on the other hand, now they're there, to be honest, they are a little bit less keen of this style of play. I do recommend you look up Pine City basketball team on YouTube and watch some of their games. It's a pretty unusual style of play, and to be honest, it's not the most aesthetically pleasing way of playing a game of basketball. You don't get any of the kind of sexy, glamorous shots that you may see at other teams, as I say. But they can't argue with the results. Since taking over the coach of the team, this 29-year-old sociology teacher has delivered fantastic results. Pine City won 12 out of their 16 games last season, which for a team of their height is a pretty significant achievement. Now at this point, I'm looking out in this beautiful venue of all of these faces, and you're all looking back at me thinking, what the hell does this have to do with investing? What on earth does this have to do with value investing, both in Europe and the US? So this story really resonated with me. I really found it interesting and very much resonated with my own experience. Back in 2013, I was approached at M&G as to whether I wanted to run the North American Value Fund. And to be honest, I felt in a very similar position as Kyle did. I felt pretty excited about the opportunity, but pretty overwhelmed at the same time. You know, to go out and try and beat the US stock market, that is an incredibly challenging thing to do. So I realized I needed a plan and I needed a strategy. And the plan and the strategy for us that we employ is value investing. So this chart or this slide here, what we're showing here is a back test or a study that we've done internally at M&G. If you've seen either myself or Richard Halley present in the past, you may have seen this slide. What we're showing is the returns for each stock market, the US, Europe, developed markets, returns by valuation quartile. And what you can hopefully see is if you just focus on the cheapest parts of the market, you get about a 1.5% to 2% outperformance tailwind on an annualized basis over that medium to longer term. So this cheapest quartile for me, this is our 3-point line. This is what we focus on day in, day out. We kind of exclude the rest of the market. We don't worry about what's going on in the rest of the market. We focus exclusively on the cheapest quartile because that's where we think the biggest pricing inefficiency is and where the biggest excess returns can reside. So how do we put that theory into practice? What's our investment process and how do we employ that? Well, we start off with a quantitative screen. And what this screen does is, unsurprisingly, it identifies the cheapest quartile of stocks. It identifies the 3 pointers. But there's a couple of points to make about this screening exercise. It's not particularly sophisticated, but there are a couple of important points to consider or remember. The first is that we do this exercise within each sector. So rather than looking across the entire market and just looking at the cheapest quartile of stocks, and right now that would just give you energy companies and financial stocks, we look for the cheapest quartile of healthcare companies, the cheapest quartile of industrial companies, the cheapest quartile of consumer staple companies, and so on and so forth. So if you think about what this means, we still find the same cheap stocks, but as a starting point, we have much more flexibility to invest in every single sector. The other point to make is the valuation tool or metric that we use. We use something called adjusted price to book. Our view on earnings is that earnings tend to be quite cyclical over time, and the danger is with PE or price to earnings based approach, you buy something, you think it's cheap on a PE, but you're just buying it at the wrong point in the earnings cycle. Book values tend to grow more in line with long-term trends. They tend to be much more stable, and so for us are a much better predictor of long-term value. So that's our starting point, this screen that gives us the cheapest quartile on a sector-by-sector basis. Now, I could go out and just buy all of the companies in the cheapest quartile, and per our back test on the previous slide, we should do quite well over time. But there would be an issue or a challenge with this. I would invariably end up investing in a number of value traps. These are the stocks, they look cheap, but actually once you do the work on them, they're cheap for a very good reason. And so really as a value investor, you want to try to be avoiding these value traps as much as possible. So indeed, that is the second stage of the process. That is our main focus when we're doing our fundamental analysis, is trying to identify and eliminate the value traps. So rather than trying to find really good companies or companies with really impressive management teams or companies that have the biggest moat or durable competitive advantage period, we kind of flip it completely the other way around. And when we're looking at the companies, it's thinking more about what can go wrong. Does the company have too much debt? Is the business model in structural decline? Does it have a management team that are a bit iffy and perhaps don't have a particularly good track record in shareholder value creation? So this fundamental analysis, this middle section here, is a process of elimination. We're looking at all the stocks in the cheapest quartile and trying to eliminate the ones that we think are value traps. The final stage of the process just kind of brings it all together in terms of the portfolio construction. Now, there are lots of different aspects to the portfolio construction that we could talk about for a long period of time. Really, the main aim of portfolio construction is that the drivers to returns on these portfolios should come from stock selection and value style. So things like sectors, we're not sector neutral, we're overweight and underweight sectors, but they're always a much smaller contributor to the expected returns and risk profile of the fund. Similarly, market cap bias, we have the flexibility to invest across the market cap spectrum, but that market cap bias, it does not come at the expense of the value bias on the portfolios. So that's our kind of investment process in theory. I guess what has it delivered in terms of outcomes for clients? Well, this chart shows the performance of the North American Value Fund in the green bars there versus the Morningstar Value peer group for every calendar year since we've been managing the portfolio. And although it's a relatively short time period, I'm very pleased to be able to say that we've beaten that peer group in every single time period. But I think what's interesting is if you think about the market environment or how the market environment has evolved over this last 3.5 years or so. 2013, 14 and 15, that was a very challenging time to be a value manager. There was a very significant value headwind. Despite that headwind, the fund has been able to do well against the peer group and mitigate some of the headwind. Last year, value did very, very well. Again, if you look at the numbers there, the fund has been able to more than capture the upside. So this is a process for us that has demonstrated that it's been able to cope well when the style is out of favour, but then capture the upside as and when value does come back into favour. This is a similar message for the European fund. We're showing the data in a slightly different way here, primarily because we've got a longer time series. So we've been running the European fund since 2008, so coming up for 10 years of track record there. What we're showing here is the cumulative excess returns versus the European index. And you can see there over time it's delivered some significant excess returns. The bars, the colours of the bars just indicate what the value style was doing during that period. So red bars were when value was out of favour, green bars was when the value style was in favour. And what you can hopefully see for the European fund, the fund was able to do well when value was doing well, as you would expect. But I think what more importantly is that it's not lost ground, it's not given up returns when value has been out of favour and we've been fighting that value headwind. So again, very similar return profile to what we've seen on the North American fund. So that's in the past, that's what the funds have delivered. I guess more importantly, what's the outlook for today is now an interesting time to be considering a value strategy, both in Europe and the US. And I think as most people will be aware, last year was an incredibly strong period for value. So these charts here, what we're showing are the performance of the value versus the growth indices, both for Europe and the US. And you can see that last year, value outperformed growth by around 8.5% in the US, slightly more in Europe. So last year was an incredibly strong period for returns from the value style. So I think a lot of people are kind of sat there and thinking, well, given how well value did last year, is now really the right time to be considering such a strategy? Have we missed the rally given how strongly the asset class performed last year? But I think you've got to think about this performance in a longer term context. So these next two charts, they show exactly the same data series, the value versus the growth index, but we're measuring it back since 2007. And you can see there that rally that we saw last year, we've highlighted that in red. You can see that is inconsequential versus the longer term underperformance that we've seen for value. So I look at these charts and I think this is incredibly encouraging. It feels like there's a huge mean reversion potential just for the two styles to get back to parity, let alone the point where value is outperforming again by that 1.5% to 2% per annum. Again, if you look at the scale of those charts, in the US, value has still underperformed growth by kind of 25% since 2007. There's a significant amount of room to go for just for them to get back to be performing in line with one another. So I find this really encouraging. Another reason we're really positive and encouraged by the opportunity set right now is when we look at what's happening to underlying valuations, both within the Europe and US stock markets. So these charts here, they require a little bit of explanation, but what we're measuring here is the valuation of the stock that sits at the edge of the most expensive quartile and how that compares to the stock that sits at the edge of the cheapest quartile. So as a value manager, investing in that cheapest quartile, you would always expect me to be buying those stocks cheaper to the more expensive end of the market. But the question is how wide or how narrow that discount is at any one point in time. So if the discount is narrow, then I would argue that's not particularly attractive. It means I'm not really buying the stocks that much more cheaply than the growthier end of the market. But when discounts are wide or when spreads are wide, that's really attractive. It means I'm able to pick up those stocks really, really cheaply versus the rest of the market. And what you can hopefully see is if you look at the situation we're in today, both in the US and in Europe, valuation spreads have rarely ever been wider between that most expensive end and that cheapest end. This chart goes back over 25 years, and as I say, valuation spreads, they've only ever really been wider in that period in kind of 99, 2000, which obviously subsequent to that was a fantastic time to be invested in value. I just want to go back to my kind of basketball analogy that I opened with in my introductory comments. You know, if you think back to that scoring inefficiency, the inefficiency between the three-pointer and the two-pointer. The inefficiency exists, but the inefficiency is fixed. It's always 2 points and it's always 3 points. The great thing about markets is that the inefficiency is changing all the time. So where we are today, it feels like the market is giving you even more points for investing in the cheapest part of the market, given how wide these valuation spreads are currently. I just want to touch on a couple of stock examples to sort of illustrate this point. I want you to keep in mind that concept that within the market, we've almost got like a two-tier up market right now. We've got an expensive end of the market and a cheap end of the market. So let's look at some of the stocks that sit within the expensive end of the market. Now, there are a number of different companies I could have chosen here, but the types of companies I wanted to talk about are the companies I think many people are familiar with, and these are the companies that lots of people refer to as the bond proxies. So these are equities, but they have been bid up to kind of bond-like valuations because of their income, their stability, their quality, and the function of the low interest rate environment that we found ourselves in. So the two companies I want to talk about are companies that you're probably all familiar with, Anheuser-Busch in Europe and Procter & Gamble in the US. Now these are great companies, they've got great brands, they've got very good market shares and dominant market positions. And as a result of that, if you look at the share price of both these companies over the last few years, they've performed very, very strongly. And you can see current valuations, Anheuser-Busch trades on 30 times earnings, Procter & Gamble 23, 24 times earnings. So these are companies that have performed very strongly and where valuations are very, very expensive. Now, you might reasonably think, looking at these charts, looking at these share price performance, looking at this valuation, that the underlying fundamentals of these companies must be very, very strong. They must be growing their earnings strongly, and they must be very, very robust. But actually, and most interestingly for us, it's almost the opposite of the case. This green line here shows the earnings per share forecast for both these companies for 2017. And you can see in the period where the shares have been going up and the valuation is becoming more expensive, the earnings forecast for both these companies has been deteriorating. And this feels like a very interesting and unusual situation. These feel like very expensive companies in our view, given these underlying fundamentals. You know, going back to my basketball analogy, these aren't 2 pointers in my view. These feel like no pointers in the current market environment when you're playing these sorts of valuations for them. What about the cheapest end of the market? What sort of stocks do we find in the cheapest end of the market? Now, the reality is the stocks in the cheapest end of the market, they are less glamorous, they're less well known, they're just less familiar with investors. So the companies I'll talk about may be companies that you've heard of, but they may not be. But they're very, very interesting in our view. The first is a UK company called Enterprise Inns that we own on the European Fund. So they run, own and manage pubs and restaurants in the UK. And in the US, we've got Magna. This is an auto parts company. So they supply drivetrain and other components that go into passenger vehicles. If you look at the share price performance of both these companies over the last few years, you can see it's been a pretty bumpy ride and the shares have underperformed. You can see the red dots there where the valuations have traded over the time and where they are currently. These companies look incredibly cheap to us. Now again, Based on this share price performance, based on these valuations, you might reasonably expect that the underlying fundamentals of these companies is not particularly attractive, that the underlying fundamentals are deteriorating or particularly poor. But look at the earnings per share forecast for both these companies. I find this remarkable. For both companies, the earnings per share forecasts have remained very, very stable. So the underlying fundamentals for these companies actually looks pretty robust and pretty solid. And there are a number of companies like this in the cheapest part of the market, companies that maybe investors are less familiar with, that have overlooked, or in sectors or areas of the market that are just out of favour, and as a result trade on very low valuations, but where the underlying fundamentals, in our view, represent an attractive risk reward. So we do think it's a very interesting time to be considering value both in the US and in Europe right now. But, and there's always a but, there are reasons to be selective. We shouldn't go out and just buy every single cheap company in the market. You know, we talked about the value traps. There are a number of value traps out there. But I think more so than ever before, there are reasons to be selective. Dave Fishwick touched upon this in his presentation, but I think that, the one thing that I've learned over the last 12 months is trying to forecast or predict the outcome to macro events is very, very difficult. Now, I certainly didn't even think Donald Trump was going to win the presidential nominee, let alone win the overall election. Trying to predict the outcome to these events is very challenging. And as Dave said, trying to predict the market's reactions to these sorts of events is even more challenging. So I think you really want to think about that in terms of your portfolios, how you construct your portfolios. You don't want to be constructing your portfolios in a way where you're betting on the outcome of one or two specific events. So, there are a number of reasons to be selective in my view. This shows the breakdown of both funds on a sector basis. We've got the European fund on the left-hand side, the US fund on the right-hand side. These are the absolute sector weightings. There isn't a huge amount to highlight here. I think the key takeaway for me on this slide is just to show the breadth of sectors that we're investing in, the fact that we're getting our valuation sources from lots of different sectors. We're not making really concentrated bets on one or two sectors. Both of us, for example, in Europe and the US, have a reasonably significant weight to healthcare. I think that surprises a lot of people, but when we look at it on our valuation framework, we still find quite a lot of value there. I own more consumer staple stocks than I do energy stocks, for example. Again, I think that's quite surprising. Now, within consumer staples, we don't own things like Procter & Gamble and Kraft Heinz, the really expensive bond proxies. We own a number of kind of special situations, companies that are going through change, restructuring, what have you, that have just been overlooked by the market. But the key thing for me on this slide is the breadth of sectors that we're investing in on both funds. I just want to bring this back to kind of valuations at overall asset class level. So if you think about the US market right now, the US market's trading on 2.7 times price to book, and the European market is on about 1.7 times price to book. Now, I think there's a tendency for kind of top-down asset allocators to kind of look at these sort of metrics and go, well, US equities, are they really cheap? Can you really be finding value when the market's trading where it is, both on an absolute basis, but also from those sort of valuations? Maybe European equities are cheaper. And, indeed, the evidence here would suggest that's very much the case. But again, I go back to my earlier comments about what's happening within markets, the fact that you're almost seeing this two-tier market of the expensive end and the cheap end. As a result of the opportunity set that we see within the US right now, we're able to construct a US value fund that is cheaper or the same valuation as the European index. So we can access some very cheap valuations in the US right now. Look at the European Strategic Value Fund, the absolute valuation, what you're paying just 1.2 times price to book for that fund right now. So, I know there's sort of uncertainty and risks from a macro perspective around Europe, but I think that's more than reflected in those sorts of valuations at 1.2 times price to book. I think that looks very attractive on that basis. I've just got a couple more slides that I wanted to leave you with. These slides for me are probably the most important slides, certainly from my presentation. So if you only remember one thing from what I've talked about today, I focused very much on these two slides. If you've liked my presentation, you think, okay, value does sound interesting, but I want to do it through maybe an ETF strategy or a passive index or whatever it might be, then effectively what you'd be buying are these turquoise bars here. These turquoise bars represent the Russell 1000 Value Index, and we're showing how that compares versus the S&P 500. So you can see currently the value index is on 1.8 times price to book, a nice big discount to the S&P 500. So you'd be getting a significant valuation discount, but look at the fundamentals on the right-hand side. Think about what you'd actually be investing in. You'd be making a huge bet on the outcome of the financial and energy sector. 45% of your portfolio would be exposed to those two sectors alone. So yes, you'd be investing in value, but I would argue, in terms of what's going to drive your future returns, it's more going to be what's happening with interest rates and what's happening with the oil price. Look at these green bars. These represent the North American Value Fund. What you can hopefully see is the fund is cheaper than the value index, so we're giving you even more valuation discount and even bigger value bias. But then look over to the right-hand side in terms of the underlying fundamentals. The sectors that we're investing in, we're much more diversified, much more balanced in terms of the sources of value where we're getting that valuation discount from. The debt to equity number there, you can see that's lower, so that means we're investing in balance sheets that are stronger than the market overall. So we're not investing in kind of financially distressed companies in order to get this valuation discount. So I think this chart is really important for a number of reasons. One, I think it's reflective of the opportunity set today, the fact that I'm able to construct the portfolio in the way that I have done. I think that shows how good the opportunity or how compelling the opportunity set is in the US right now. The other reason why I think this chart is important is I think it helps explain how the fund has been able to deliver the sorts of returns it's been able to deliver in the past. The fact that we've got this big valuation discount has meant the fund has been able to do well when value style comes into favour, when we get the value tailwind. But the fact we've got those strong underlying fundamentals on the right-hand side has really helped when value has been out of favour and has really helped us to withstand that headwind in some of those more kind of challenging periods. This chart shows exactly the same thing, but for the European funds. So this is the main European index. This is the European Value Index, and the green bars there represent the fund. You can see exactly the same phenomena, so I would argue exactly the same opportunity set. The fact that we're able to construct the portfolio in a way that's cheaper than the value index on price to book, but the underlying fundamentals on the right-hand side look much stronger. I mean, look at that, look at the financials weights there. 40% of the European value index is in financials. That's a huge bet you'd be making on European financials, which, given some of the issues that James Tomlin's talked about with the Italian banks, I just don't think that represents an attractive risk-reward. So we do think this process is one that's very attractive from that perspective. To conclude and bring it all together, I guess it's good to remind people that value is a proven strategy over the medium to longer term. Buying that cheapest quartile of stocks day in, day out, that does tend to outperform over time. Yes, value did well last year, but I think you've got to think about that performance in a longer term context. It feels like there's a huge amount to go for from where we are today, both from a performance perspective and because of what's happening in underlying valuations. But again, just re-emphasise that need to be selective. We do need to be selective, but the risk-reward is very much in our favour, we feel. So with that, I thank you very much for your interest and attention this afternoon. I'm happy to take any questions.
Thank you, Dan. ¿Alguna pregunta para Dan?
Have you got a question?
I would like to know which one, in your words, your biggest valuation mistake that you've done. What happened, and what did you learn from it? Thank you.
Gosh, that's a really difficult question. It's a great question. I'm already stalling for time to try and think of a successful answer. So on the European funds, certainly the biggest mistake from my perspective is we back in the back end of 2008, I did a lot of work on Bank of Ireland. So if you think end of 2008, it's right in the teeth of the financial crisis, kind of Lehman Brothers is going bust, Bear Stearns is going down, banks are trading on kind of 0.1, 0.2 times price to book. So we were looking at Bank of Ireland thinking, okay, this is primarily a retail bank. It was on 0.3 times price to book. Yes, the Irish economy is overheated. Yes, there's going to be losses on the mortgage book. But I did a lot of analysis and felt that they could withstand those losses. It was also at a time, so we bought shares in the company. It was also at a time, I don't know if you remember, but pretty much every day, every single bank across Europe was coming out with new disclosure in terms of what they held in terms of their treasury portfolio. And whether it was subprime CDS, whether they had off-balance sheet conduits, SIVs, CDOs, what have you. Anyway, we'd had this position in Bank of Ireland that we bought on my recommendation. They then came out with their disclosure on their treasury portfolio. It was complete garbage. They owned absolute rubbish in their treasury portfolio. And it completely invalidated my analysis in terms of whether they could withstand the losses. Now, the great thing, I think, about our investment process is we're focusing on those value traps. So when we get new information that just proves us wrong and says, you know what, you either missed something or there's been new disclosure that's come out that says this is a value trap, we don't have any emotional attachment to any of the companies. I don't have to kind of try to re-engineer my investment case as to why I should now still hold it. We sold out of it. We sold out at a loss, but if you look at what happened to Bank of Ireland subsequently, it was the right thing to do. So that, for me, is probably one of the most painful experiences. But I think, it kind of goes with the territory, the sorts of companies that we're investing in. They're often companies that are going through some sort of challenge or issue. We try to avoid as many of the value traps as possible, but we do end up having some that come into our portfolio.
Muy bien. ¿Alguna última pregunta para Dan? Si no, lo vamos a dejar aquí. Muchísimas gracias.
If no, thank you very much indeed for your presence. I will remind you that you should fill out the questionnaire and the surveys, so we'll try to improve the content of our next sessions, and you have got a cocktail downstairs. Thank you very much.